The stock market is dropping. Everyone has an opinion, and nobody is telling you what to actually do with your money. That changes now. Jed here with Arkeo Financial. I've been helping families, business owners, and professionals build and protect their wealth for the last 14 years. By the end of this video, you're going to know what a correction actually is, why it's normal, what the data says about investing during one, and the exact decision framework I use to figure out what to do with your money right now. Let's get into it. A market correction is technically defined as a drop of 10% or more from the recent high. That's it. Not a crash, not a crisis. Just a 10% down. A bear market is 20% or more, and a crash is a fast and severe downward swing, like think 2008 or March 2020. Right now, we are in the pullback that is approaching correction territory. Not a crash and not yet a bear market. Here's what the financial media doesn't emphasize enough. Corrections are completely normal. Since 1974, the S&P has experienced over 27 corrections of 10% or deeper. That's roughly one every 2 years. The S&P has also averaged an intra-year decline of about 14% every single year since 1990. Even during those years, that finished strongly positive. In other words, a falling market is not an emergency. It is a predictable pattern or event that happens on an irregular calendar. A dollar invested in S&P 500 in 1926 would be worth approximately $20,000 today. Through the Great Depression, through World War II, through 2008 financial crisis, through COVID, and every correction in between. The single variable that determines whether you get that return is staying invested. For Canadian investors, specifically, the picture is actually less scary than the headline suggests. The TSX finished in 2025 up 28%. It's the best year since 2009. And the top performing North American index that year, there isn't a single cause for correction. There's 4 things hitting the market simultaneously right now. And that combination is what makes it feel worse than a normal pullback. Cause number 1, why it's moving the market. The Iran war or Strait of Hormuz, right? Because when there's the oil supply shock, the energy drives inflation up. And when there's more cost for transportation, it also drives groceries and everything in between. And that's extra money that you cannot use for investments. Canada may hold or raise rates based on that because of the stocks and real estate as well. Reason number 2 is weak Canadian jobs. There has been almost 84,000 jobs lost in February. It's one of the worst non-pandemic months on records. Unemployment is at 6.7%, and consumer spending and fears is rising. Number 3 is elevated valuations. The S&P 500 trades at 22 times its forward earnings versus a 5-year average of 20. The CAPE ratio is near 40. It's the second highest in history. So expensive markets correct harder. Number 4 is midterm election year. Historical data says that S&P 500 averages only 1% return in midterm years with an average of 18% intra-year drawdowns. The pattern is repeating. Out of the 27 corrections since 1974, only 6 has turned into bear markets of 20% or worse. That means there's almost an 80% historical chance this is a correction, not a crash, and that it recovers. The average correction lasts about 17 days, and those are your base odds before we even look at today's specifics. Whether you should invest right now comes down to 4 questions. Answer them honestly, and your decision becomes clear. Variable number 1 is what is your time horizon? If you're investing money and you won't need it for 10 years or more, history is almost unambiguously in your favor. Every correction in the market has been followed by recovery and new highs. The S&P 500's average recovery from a correction is about 4 months. From a bear market, it's about 6 months to 2 years. And if your time horizon is long, corrections are discounts. It's actually a better time to put more money in because everything is on sale. If you need this money in 1 to 2 years, that changes the calculation entirely. In a worst case scenario, where this becomes a bear market, you may not have time to recover before you need the funds. In that case, staying in liquid cash or bonds makes more sense than buying equities or stocks. And this is where Canadians have an extraordinary advantage that most people underuse. If you have unused TFSA room in 2026, there is up to 109,000 in cumulative room. A market correction is the ideal time to deploy it because every dollar you invest in a downside inside a TFSA grows completely tax-free. You're buying assets at a discount and sheltering them from future taxable gains from the CRA. The same logic applies to an RRSP room. Investing in a correction inside a registered account is the highest expected value for a move from a Canadian investor. Here's the question I constantly get. Should I put all in now or wait? The data actually favors lump sum investing in most cases. About 68% of the time, lump sum beats dollar cost averaging over a 12-month period because markets trend upward more often than not. Here's a psychological reality though. If you invest in lump sum and the market drops another 10% next week, you need to be able to hold without panicking. And for those people that don't have any lump sum, there's actually another strategy that can help you so that you can create bigger capital to invest right away. Now, a setting amount every week or every month, regardless of price, that's called DCA, and it removes timing anxiety that builds discipline. The best investment strategy is the one that will actually stick to. For most people, that's a regular automatic contribution that ignores the noise. You stay the course no matter what. However, not all asset classes perform the same in a correction. Right now, in this specific environment, there are parts of the Canadian market that are actually thriving, and there's parts that face real headwinds. Oil is actually going up, right? Gold is a good place to have a steady hedge against the volatility of the markets. So, should you invest right now? Here's my honest answer. If you have long time horizon, unused TFSA or RSP room, and you're buying diversified assets, then yes. Not because the market is guaranteed to go up next month. It might not. But because trying to time the perfect entry point is a loser's game. As Peter Lynch put it, far more money has been lost by investors trying to anticipate corrections than has been lost in corrections themselves. The market goes on sale once every 2 years on average. Right now, it's on sale. The question is whether you treat it like an emergency or an opportunity. History says it's an opportunity. If your time horizon is long enough, let the math do the work. Let me be specific about who this applies to because it's not the same for everyone. If you're a long-term investor and you have unused RSP or TFSA room, invest now. Use registered account, buy on sale, use tax sheltering, maximum value. History strongly favors this. Medium-term investors, 3 to 10 years, some cash on the sidelines, dollar cost averaged is in. Don't lump sum it, it will cause anxiety. Removes timing risks, builds discipline, automates everything, and captures recovery regardless of the exact bottom. Short-term need, less than 3 years, near retirement, stay defensive. Prioritize capital preservation, keep cash, short-term bonds, or other liquid assets that don't have much volatility. And a 2-year bear market is a long time. If you're close to needing the funds, don't invest. Mistake number one is panic selling. Panic selling locks in on a paper loss and turns it into a real one. You sell at the bottom, it's bad. Worse, now you have to be right twice when you get back in. If you lose 50%, you have to make 100% to get back most of it. Most people who sell in a correction buy back after the recovery, which means they missed the entire bounce. The data on this is brutal. Missing just the 10 best trading days in a year typically cuts your return in half. Mistake number two, waiting for the bottom. The bottom is only visible in hindsight. Nobody knows where the bottom is. Nobody knows it in COVID. Nobody knows it in 2008 or any other correction. Investors who did the best weren't the ones who timed the perfect entry. They were the ones who consistently bought throughout the decline and held through recovery. Waiting for certainty means waiting for prices to go back up. Mistake number three is concentrating in one sector. The energy sector is up 25% year to date. That's great, but chasing one sector is bad. When the Strait reopens, the oil drops back to 70 and energy stocks give back half their gains in 2 weeks. Diversification is not just a cliche. It's a geopolitically volatile market. It's risk management. A market correction is normal. It happens roughly every 2 years and has always recovered. The current pullback is driven by 4 simultaneous pressures: oil shock, weak jobs, high valuations, and a midterm year. Whether it's to invest depends on your time horizon. Use your registered account room, look at your risk tolerance, and look at what you're buying. History strongly favors investing through corrections, not waiting. If you want to know exactly how much TFSA and RSP room you have and the best way to deploy it in this market, DM me the word invest and I'll send you a free 3-step framework for investing through a correction. Or book a call directly. The link is down in the description below.